Welcome back to another episode of Reinventing Finance. As usual, I'm not all by myself. I'm joined again today by my lovely co-host, Tom. Tom, how are you today?
Thank you, Nick. Looking forward to our conversation.
And as usual, Tom and I are not just in our own little echo chamber, and we have another very interesting guest with us on air. Toby, how are you today?
Very well, Nick. Good to see you again. We are in the UK having 24 hours of storms just coming through, and hopefully we move on from there.
And these are natural storms, not political storms.
One hopes so, but they follow in quick succession at the moment.
At least that's what the papers tell me across the narrow sea. Toby, I couldn't do this justice myself. It's also less work for me to prepare. So why don't you briefly introduce yourself? You know, who are you and what the hell do you do?
So I'm Toby Stubbington. I've been involved with insurance, say, for the last decade. That's primarily with a couple of roles in Pier Insurance, which has, for the last 20 years, been a specialist in gadget and mobile phone insurance across various distribution channels, UK and Ireland predominantly. And have been running that business for the last 5 years alongside an acquisition we made just pre-COVID of Ticketplan, which is involved in the ticket cancellation insurance space and ticket refund protection. So some really interesting consumer-facing products, which we distribute either gadget via B2C and or B2B with our partners, and Ticketplan solely through partners and embedded insurance routes, as it were. I've loved the last 20 years being involved in subscriber businesses of one kind or another. Lifetime value is interesting, and I'm an accountant by trade. I find the analytics and the engagement with the customer over those journeys interesting. These aren't transactional. These are about building value, brand value, relationships, and of course trust, which sits behind insurance, one hopes.
Could you share how how big is Pier? You don't need to give us the premium, but maybe the team, as I'm also then going to segue into, there's some big players out there, and I would just would interest me how you compare and contrast in a market that seems to favor size, but clearly you're not experiencing that.
No, sure. Pier has around 40 employees. They cover the gamut of underwriting experience through claims and a claims team, through various connectors and our own repairs team. So we work with relationships and partners, but equally our 20 years of experience, if I just talk about the phone and gadget side for a moment, gives us the ability to finesse routes and customer journeys from one end of the lifetime, which will be at point of inception, all the way through to dealing with some fairly complicated claims or fraud. So yes, you're right, scale gives advantage. It equally gives some disadvantages, and I think from our partners and customers, our knowledge capability and the ability for the team to finesse those journeys and share experience, i.e. we don't work in silos. We are not focused on significant integration either of acquisitions or for that matter TPAs, can be a distinct advantage.
So would it be fair to say it's as usual, there's always two sides to a coin. Size gives advantage, but on both ends, and you are you're essentially more nimble, and have also by now a track record and experience that others might still have to build or acquire more at a high cost? Or what would be was there anything specific to your business model that favors a certain size above and beyond, let's say, the textbook pros and cons of, David against Goliath?
Well, if I give you a bit of sort of context to Pier, that might help. So 5 years ago to 7 years ago, we were mainly paper-based in terms of claims. We had a sort of cloud system for looking after premium and policies. But actually, we've taken a lot of learnings quite quickly. We're a bit like magpies, but we wait for how we've finessed our systems and digitized. So I look at us now, and we are as insurtech, perhaps as many other insurtechs, although it does vary somewhat in terms of the markets and use. But we really get the product too. The board, myself, have all been involved in mobile phones for a long, long time. Understand the industry, understand the distribution channels, and understand claims and fraud that exists in this space as well. So we are, let's say we have this layer of knowledge and experience, which you can acquire, you can recruit, but ultimately it's about forming a business that makes sort of valid commercial decisions over time. Now has this digital tech layer that we have actually made bespoke and proprietary to our needs and the needs of our customers. That means we have a great deal of trust and a strong relationship with our underwriters. They understand how we do what we do, and that means we can move through all claims quickly and understand where there may be fraud, whether that's opportunistic or network. We can review our claims in real time, optimize for average cost of claim whilst keeping that claims experience high. And what I mean by that is you will often find larger businesses still outsourced to TPAs. There's a multiplicity of stakeholders in insurance. Our area, we're almost like a quasi MGA. We have taken out elements of friction. So yes, we could scale significantly based on the platform we have now. We probably couldn't have done that 5 years ago. Yeah. So I think our advantage is we are optimized for customer journey, optimized for having a good profitable business that can service the various stakeholders. But ultimately, I believe we're now primed and in a space that enables us to compete. And Nick, you're absolutely right. In terms of businesses with significant capital and the right structure behind them, they have an advantage. But ultimately, incumbency, silos, integration of acquisitions can take time and focus, which clearly is something that we are free from at the moment.
And I think one thing that I wasn't so aware before listening to you, which is why we do these podcasts, right? Me and Tom are the primary and the first, not the only ones, but the primary listeners of these conversations, obviously, as we partake. But what you've just mentioned is, a high level of vertical integration allows you to remove friction across the chain. If you have a lot of capital, you also need to deliver a lot of growth because that capital wants to have a return. Now, that increases the bar of opportunity, because maybe all of a sudden you say another, let's say, 200,000 of premium might convert into, whatever, 30,000, 40,000 of recurring commission for your business or whatever that is a worthwhile opportunity. If you need to return, I don't know, Baltic just raised another 200 million. I don't know, you need to stack up a lot of these 30K deals to reach that. And ultimately, it's a similar cycle. Equally, your partners become bigger, they become more complex. And thus, in order to fulfill this quickly, you need to partner with TPAs who on the books have broader existing structures where you can offload some of the internationalization or volume. But that invites then the friction. So the requirement for big deals means usually larger reach, more complexity, invites more outsourcing, because usually you cannot build everything yourself, and that drives complexity, and ultimately is one of the key disadvantages of larger organizations, right?
That's right. And it does, for the best large organizations, create moats, creates an incumbency. Yep. But as we know, digitizing and having good owners, and they could be PC, they could be VC, they could be PE, they could be private, or listed businesses with good structures behind them, enable you, I think, to be efficient, to work efficiently, and maintain a level of profit. It feels to me it's all about the customer, isn't it? It's all about your partners, and the minute you take on that scale, it's sometimes hard to service quite in the way that you should do, and it also breeds perhaps a level of complacency, or teams that churn and aren't quite so closely connected to the business, sometimes to the actual business and the coalface.
I have two follow-on questions. So I read an article recently about Extent. It's the Apple Care for Everything, the high valuation United States. And what they've done, and quite frankly, others in partnerships, and this has been done in big partnership deals, you call it a different name, but ultimately, you pay someone a lot of money, with commissions or just, upfront, etc., to win the deal. And they've done some very, on a normal commercial window, you wouldn't do these deals, right? However, if you just need to raise the next round to win these deals. So what's your answer if I come along and say, yeah, okay, these Toby and his team, nice. But now you need to go to the next level. Come work for me. I'm this big shiny thing. Everything's cool. And by the way, I'll match everything that they do, but I'll give you an advance of probably the next 2 to, I don't know, next year's premium, or, I'll just chuck another $1 million on top of it, because for me, it actually might make sense, because I'm raising on top line, and that extra $1 million might actually reduce my financing costs by, 20, 30, 80%. So it might make commercial sense for me. How do you counter that? Because that is a very strong, someone coming in with a lot of money.
Yeah.
And from the outside in, let's say they can still, let's say in the sales cycle, it is still difficult to differentiate quality, right? It's sometimes difficult until you meet the lack of quality to really appreciate it. Have you encountered this? And what's your answer if it ever were to happen?
I've encountered it throughout my career, and more recently. You see it in B2B, we see it in ticketing and with promoters, we see it across actually B2C marketing as well, where there's a sort of a level of marketing cost to get away, and you may be questioning the CPAs around that. It has a similar impact, right, in terms of share of voice, in terms of impact on market. Both the businesses are highly credible in terms of how long they've been in these sectors. What comes with that is credibility of being around, making the right decisions. It helps with the various stakeholders. It also means relationships exist. They're important. They're an asset. They're another sign of goodwill and faith, because ultimately all business is still about people, right? Of course, you will find some tender processes, some other, some other ways of winning business. I mean, you may be out for that round. What I'm seeing more recently, and this isn't specific to phone insurance, is some of those larger areas of spending, which don't, may have been rationalized through means of arbitrage of value of business or cost of capital, are not working so well, perhaps in an inflationary environment. perhaps one with some greater economic stress associated with it. I'm thinking of the ticketing sector more recently. And no business can continue to write that level of spend, as it will end, particularly if it's in certain sectors, as it will end up destroying its own ability to forecast margins later. Yep. So it works for perhaps a short to medium term objective, and totally get it. But ultimately, most businesses and sectors will have will reach a plateau, and then we'll revert to something which works for the various parties and the economics within those sectors. But it is disruptive. That those areas of capital spend can have an impact, of course.
Can you just, let's say, mention some very practical examples? Because let's say you're around for such a long time, and then, I mean, if you talk about experience, there's positive and negative experience, and of the negative experience, there's stuff you wouldn't have been able to avoid in hindsight. Most extreme example would be, let's say, this whole black swan stuff, something which is there, which hasn't been there before. But there's also stuff, let's say, if you become more experienced and you exchange with other, let's say, people in the same business or with entrepreneurs or something like that, then you find out, oh, this stuff which went wrong in our company went wrong in all those other companies as well. So, or I would have done in hindsight, I would have done it in a different way. Is there something?
Yeah. I'm not. Let me try and play that through, Tom. I think context is important, but most industries face this. How you create value in long-term relationship. Clearly, if you're able to not just look at the now, a short-term relationship, and increase it to multi-year, that can help. If you can look at the party you're looking to do business with, and create value with them over time, that can help too. It may be to do with sharing of customer bases. It may be to do with supply chain and what you receive from your customer and how you can assist them in terms of their margins. That can create additional value. I also think that it's been an interesting last few years for insurance. It's been abnormal. Certainly when I look at phone insurance and ticketing, in terms of claims experience, in terms of how to price. And I suspect there's underwriters do a fantastic job in looking to price. But if you were to take experience of the last few years and use that as your benchmark for the next few, you're likely to be out by quite a large margin. I have seen in other industries the ability to create win-win situations based on the future ability of something to perform. That could be something that might work in the insurance space. Nick was asking me a few questions previously around the phone and gadget ecosystem and the various parties in it. Many industries have consolidated, and by that I mean where you would have had various parties involved in supply chain, they've tended to all be looking for the same share of wallet. I suspect there's the ability to build some terrific partnerships over time going forwards, particularly as economies move towards a more circular approach, where you can share long-term value. We're always going to come across somebody who's making a decision for a reason which isn't to do with the unit economics of that market at the time. I think it's about building out a partner and customer proposition where they can clearly see the value and be confident in what it is you're selling and why. Yeah.
I just mean, for instance, let's say, if you zoom out, I would say we value short term over long term. It should be the other way around. We were much more focused on growth, and we should have been much more focused on profitability. we were focused on valuation, and we should have think much more profoundly about dilution or liquidation preferences. So this kind of stuff. But I think we lived in exceptional times. There was just too much money around. There was an enormous pressure, and also a kind of social pressure. So if you was not on the stage and telling journalists that your last valuation was even higher than a half year before, you were a loser in this whole ecosystem. Just to mention a few of those examples, and especially in the insurtech business, I think that combined ratio will be much more important again, instead of revenues, for instance, because I mean you can buy revenues, but if you acquire the wrong clients, and you already, if you are honest, already notice that you are acquiring the wrong clients, then you will just be punished for this, let's say, in future. The question is, you don't know when you will be punished by a higher combined ratio. So, and all this kind of mechanisms play an enormous role. And the more you depend on, let's say, valuations and next capital rounds, the more it can harm your business.
I've been in the luxurious position, and it's interesting that I say that of been running private limited businesses for the last sort of 5 to 10 years. And I say that because we have had to have gone through with both businesses COVID, which has brought with it huge volumes of either claims or sales, depending on the businesses I look at, and trying to work through those combined ratios in a way where history and experience and a good relationship with the underwriters count for a lot. So my prism, as it were, that I've been looking through is very different from an insurtech that is raised and is looking for growth, and to a degree growth for almost any sake in that sense. Anticipating and understanding product and fraud on the gadget side, or actually for ticketing likelihood of frequency of claim, are significantly important, because it means you can have the right conversations with partners around pricing, for example. I think most credible businesses are looking for partners who can offer them durability and flex when they need it. As you say, Tom, it's been quite a volatile period after something which was quite benign after 2008. And I think tried and tested experience will come to its fore during that period of time. You know, knowing how to optimize a business, knowing how to optimize systems, processes, and people, and ultimately, it's down to the customer, the partner, and good relationships, but equally the people in the team, and making sure they're empowered to make the right decisions and communicate when they see a problem. New teams which are integrating, teams where there may be different alignments of interest are hard, in my experience, to do that with.
Yeah, and sometimes, we all have our forecasts, our plans in one, form or the other, but also having some form of feedback mechanism that appreciates that the world has also dependencies and uncertainty, and some things cannot be just fixed in a month. And it's kind of these jolt. You get this massive fundraise, you need to do all of these things, and the point is, if you need to do things fast, you usually require more resources for the same distance as if you can take it a little bit more considerate. Going fast, being quick, requires more resources, not less, than doing it sometimes considerate, because you're making mistakes. There's just costs associated with it. And in the market,
Nick, that's a really interesting point, because I think when you grow fast, and I think growing fast is a good thing, because it gets you that sort of revenue expectation and cash flow in which you can use, but what it also means is you're focused on the here and now and the first thing in the chain. And by that I mean I have worked for startups. I worked for a startup called Easy Car soon after qualifying as an accountant. It's a car rental business, disrupting car rental. It took market, it established branches, 7,000 vehicles, but actually the lifetime of those vehicles, which you could equate to the lifetime of a customer taking insurance, you've got to plan for those moments of change. That could be delivering a car back. It could be finding a car that's been stolen. Suddenly you've got significant refurbishment costs. Suddenly you realize perhaps that your premium or car rental per day isn't sufficient to meet the needs of the claim costs across that lifetime, or handling those difficult points with a customer, which may be MTAs, it may be change in devices, it may be looking to recover funds that haven't gone through the card in the right way. Those I've seen quite a few examples of businesses growing quickly and on the back of capital raises where there just isn't time or the resources to plan for those next steps. So you can see a lot of growth and then an issue.
And I think, and then I think we can, I mean, we could spend tremendous amounts of time because this is a super interesting topic. It's a universal topic. But I think one of the big problems is when venture capital or investment capital is not spent on, let's say, investing something into a product so that you can say, if I'm investing this now, I can multiply it across multiple parties. And that creates a competitive advantage because I simply cannot charge consecutively or in parallel enough clients to make this investment worthwhile to be able to provide these unit economics. Whereas, especially in insurance, a lot of the investment went for customer acquisition. And that's something else. And I think that ratio makes tremendous difference because obviously the way software in an ideal world works, you do it once, you replicate it at near, zero cost to everyone else. So there is a good benefit to investing and then kind of distributing it. But that might not go so well if you need to pay for your revenues, if you need to acquire distribution channels. So I feel it really depends on what you use that money for and how durable that benefit really is. And so, I think it's a complicated, it's not a black and white, life is gray answer of how alleged David can beat alleged Goliath,
One other point to conclude, perhaps on this area, is reflecting on it. Pier, I'm told from time to time that you should focus on B2B or B2C. Pier has a great couple of brands, the marquee one being Love It to Cover It, which sells directly through e-commerce, phone and gadget insurance to customers. That being at the coalface for that product in that way means what we've built is better for our partners and our partners' customers as well. And that's something which, from a valuation model, from an understanding of it might be questioned, but actually I believe our partners are with us because we understand customer journeys. We're of the size we are, which has meant when I, 5 years ago, started to run this business, I was putting calls into customers who left 1-star reviews on Trustpilot because I was uncomfortable that we were getting their journeys right. That led to some of the changes that were made in the business. So tough stuff, but actually, a business that's flexible enough and feels emotionally attached enough to the outcome, which I believe a lot of the team that I work with are, and they're interested in their personal development, the development of the business, the development of the customers, means we take the same approach to partners as we do with customers to try and create those situations for long-term value on both sides. It makes it an enjoyable journey.
No, absolutely. And I think that's a very interesting point. And it's just, again, you kind of need to understand. So from an investor point of view, they prefer pretty clearly separated assets that they can create their own portfolio, because that's preferably from an asset allocation, return on investment point of view. And I think there are examples of inefficient conglomerates, but there's also examples of very efficient conglomerates. And I think it really depends on whether you believe by expanding the problem space of your partners, your clients, you can potentially create more value and cross-subsidize certain things or reduce complexity. And, then at some point, someone would say, okay, you need to have delivery complexity, you need to manage that. But I do understand it's just very easy for someone to say, I'm a SaaS business, sanity check. And most investors either like B2C or B2B because they're thesis driven. They'll say B2B, you cannot do both well. It's kind of these truisms that then come, you need to focus 80-20, and they sound really smart. And in 80% of the time, they might also be true, but in certain elements, they might cross-pollinate. And I've certainly seen that in insurtech, in B2B, in having your own B2C channel, where main point is you control the entire journey, you get data. You can then decide on whether you want to outcompete on someone else's marketing spend. Clearly is easier to tell a story. And by story, I don't mean to lie to someone or to trick someone, but to coherently say, these are all the things you need to care about. And this is my recommendation. Now let's talk how what we've learned when we control the entire journey, that can work for yourself. And it's just way more believable than saying, I'm just a product, I'll have an implementer and someone else needs to distribute it, because that makes it difficult to understand why certain attachment rates don't work, etc. Ultimately, you need to understand how your product works.
That's right, front end and back end, and that knowledge can create stronger partnerships. And ultimately, I think for any insurer entering either of the gadget and or ticketing spaces, you need to work with trusted people who either have the experience or all the systems and connections or connectors, as it were, to enter a market wisely. You can otherwise burn through quite a lot of cash, and actually the opportunity cost of time, I often think, is more important than the cash to some degree. Making the right decisions in the right order helps to embed an approach that's likely to bear fruit rather than one that people step back from over time because the project isn't delivering.
I think if it's okay, I would like to segue into maybe more the specific aspects of device insurance, etc., because that might be interesting for a lot of our listeners, as it's a specific product line. And I think that's something, aside from, let's say, the more kind of general themes that we've touched, you are also a very believable expert in. And you've almost always, as if I'd shared the questions before, segued into the next question. And that would be, let's say you, in another life, you would have to or wanted to advise a general insurer. Take your pick. I don't know. It could be Aviva, it could be AXA, it could be a regional, it could be a mutual, but someone to enter the device protection space, the gadget protection space. What would be your 3 or 1 or 5 main advices, or even better, if they were to say, Toby, run our B2C and B2B business, you're going to be flush with cash, etc. Under which conditions would you even consider taking the job so that you're primed for success? Because you're not starting with a blank sheet of paper, you're starting with a framework, with experience. So what would be your advice, or what would be the preconditions for you to take on something like that?
Try not to respond generically. It will be down to people. So having the right underwriting experience that gets seasonality in the product, that gets that each distribution channel comes with its own challenges, whether it's a connected device sale, which will clearly come with less fraud to begin with in it compared to a B2C book, or an area of large scale like bank assurance and some of the elements and sort of aspects associated with that. I would absolutely want a system with the right connectors in it, with workflow for claims and visibility over claims. If it was B2C and direct, I would want an understanding of the customer base over time too, prior to claim. To understand what's there, what devices are there, how to ensure they are efficiently processed. I'd want to ensure that absolutely we were using the right partners for servicing of those claims too. And probably I would want to be focused on very early on our renewal sequencing and communication into those customers if it was direct. Because it is all about retention. To my mind, it is about lifetime value. It is about the ability to build out a relationship on an ongoing basis with those customers. If it were partner based, then I would want to, clearly be understanding early on what is the business that is being brought on, and whether there is any ability to optimize those distribution channels with the customers. So, whether it is, and they all still exist, whether it is e-commerce, whether it is telesales, whether it is field, and actually get some really good key account management and engagement with those teams. So actually you are building out that end-to-end process with those partners and embedding sort of good process and insight into that workflow. If you can achieve that with people with knowledge, and by that I say not just the last 2 to 3 years, but actually longer than that, and help to imprint that on some of the younger members of the team, you should be in good stead. But Nick, I would say that partnership business in insurance, and I've experienced this both in gadgets and phone and in ticketing, takes a while. You've got to actually manage expectations internally, and if you're in an insurer, you've got to plan for a multi-year journey here. This isn't a quick fix. If it is, you are probably spending a lot on marketing. You are probably, at least in the UK, operating through price comparison websites in a large way, and that may not give you, what you need in the longer term. Each European market or global market is different too, so it's about understanding those specificities, how you can work with the mobile networks, where databases exist for things like IMEI numbers, so the unique identifiers of the devices and the like, in order to set your framework up to work with these devices over the course of their lifetime, and spot potential fraud and the like with them too.
One, and noted down, I think that all makes sense. I think one of the really important ones when you kind of go into larger corporate is expectation management, and time and lumpiness of success. It's kind of nothing. It's one, right? It jumps. It's usually not incrementally building up. One thing, because you've just mentioned it twice already, I just want to pick in. What was so different over the last 2 to 3 years? How was the market out of sync? Was it more claims, lower claims, more purchases? Why are the 2 to 3 last years not representative? And so it's you cannot really extrapolate from those experiences.
Well, if you can imagine, we all in various territories went into different types of lockdown or different behavior. Yeah. this behavior meant that our cars were often sitting in their driveways, our phones were sitting next to our desks, and we may have passed them on, various gadgets, onto the kids to use for their homeschooling, right? So that is, if I look over the last few years, that is what's been happening to our phones and gadgets in our lives. So prior to that, there would have been seasonality in claims around the summer holidays, around the Apple bringing out new devices or Samsung bringing out new devices, etc. There was a familiarity of pattern, both from a sales perspective to a degree, in terms of the demand for the product and the demand for the devices. That changed notably in different ways, and there's just the frequencies of loss and theft went down for some periods quite significantly. So you will have to smooth in order to get a better understanding of what claims performance was actually like. We have seen over the last year a returning to normal of frequencies around AD, so accidental damage, liquid damage, more recently loss and theft, as people have traveled abroad more for holidays, etc. That's kicked in, as people are going out and socializing more too. So I'm just saying, if you don't have that inherent understanding of how to of where you should price, or where the data may not give you the answer you're looking for, I think that could potentially have an impact on pricing and core over the next few years. Devices have got more robust. They are getting to a stage where they will be easier to repair eventually. But I just feel, looking at the market now, looking at pricing, we have to have a sense that there is a potential for misalignment over future behavior and frequencies and current pricing.
Awesome. I think that that segues a little bit into, because claims changes during COVID and post-COVID, we've mentioned that. But are there some other general trends that you think are also informative about the future, or what things do you expect to potentially continue that will impact this? Let's leave out the stuff that's irrelevant, that's noise, for simplicity's sake. Any developments that you expect to continue or to happen in this market?
Well, let's talk about trend, and let's step back from insurance per se and look at the underlying devices. Yeah, so those devices, at least in the UK and many other markets, used to be bundled with network airtime. So you'd get your phone, you pay a certain amount for network airtime, and then that contract was renewed every couple of years. You'd get a new phone. SIM only had and other ways of buying devices are radically shifting that market. There's leasing available now for it. You can trade in devices that you wouldn't have been able to before. You can go out and get your own SIM and network airtime to go alongside or separately from. You can clearly do that with insurance as well. I mean, we're in that space, and that's all led to a longer retention of device, as those new devices have also gotten more expensive. So there's been an economic imperative around it too for the customer. That increase in retention has also, as well as the relative costs and perhaps an emerging understanding of the environmental impact of these devices, has led to a larger refurbished market for many types of gadgets, but predominantly for phones, tablets, MacBooks, laptops, that side of the market. And I expect all of those trends to continue, i.e. more rental, more refurb, more abilities to trade in, more flexibility perhaps in how we repair, and perhaps over time the ability to repair more devices too. Just touching on some of those environmental points a second, you know, if I go back to when I was a child, many options would be available to rent. There'd be many options available to get consumer goods, electronic goods repaired. Over, you know, particularly with phones, my early phones, I could swap out a battery. I could buy a battery, put a battery in. All of that flexibility was removed from the market over time. We now see it coming back into the market. The ability to repair, those repair movements, the things like the repairability indexes. So, you know, I see retention of devices and length of retention of devices perhaps extending, the lifetime of devices extending again, and actually what will be very valuable alongside them are the right repair offerings and insurance offerings in order to continue to have those devices serviced.
Let's dig into that area a little bit, as I'm kind of looking for, and the list isn't like a long list of simple to very complicated ideas that, you know, insurers can do to move ourselves to net zero. Or I think gadget insurance, as you've alluded to, or not alluded to, as you explicitly stated, have certain interesting components that lend themselves, let's say, more easily to a more circular economy than potentially, I don't know, a legal risk insurance, right? I'm making this up. Maybe it does. I don't know. So if you were to advise, or if you were to design from easiest to most complicated or most difficult, and most difficult can be, it'll be more costly, it'll be margin, you'll have to orchestrate more. What would be your kind of 10-step program to, this is how you make the insurer, this is how you make your gadget insurance more sustainable? What is the laundry list of things? Ideally, we can restructure it later, but ideally from easiest to most difficult.
I'll start by saying that this product inherently has some alignment to circularity anyway. We as the customer generally are both interested in having a device repaired rather than replaced. You know, average cost to claim lends itself to that. Having a device in the customer's hands most quickly, which is their device, is important too. Equally with these devices, ones that can't be repaired, so they're beyond economical repair, it makes sense, doesn't it, to ensure that value is created from those devices to ensure that the average cost to claim and therefore premiums stay low. So those concepts have always existed for this. Is
that called
product.
subrogation, or is that from marine insurance? Isn't that where isn't that called subrogation, where you pay the claim and then someone needs to dig up the old ship from the ocean floor?
I think that's go as far as that, but yes.
Maybe I'm making this up, but just from uni. But basically, it's beyond economic repair, but there is a value to it. You know, I have these iPhones, probably has some lithium, or, you know, has some stuff in it that, you know, otherwise need to be dug up in China. And what do we do with them? Because if I have a few, probably some others also have a few. What do we do with them? Is that what you mean? So how do you?
That's what I mean. So ultimately, the product only works and works well where you have that concept of recycling or potentially reuse. It's mostly BER leads to recycling of components, which of course are securely wiped, etc. So that exists now, but ultimately, if you're really looking at
because you've just mentioned this as a little side note, I remember that we were trying. I'm not so active anymore, but I used to be more active in a one of these social clubs. It's a round table. It's like Lions or Rotary or whatever. And we wanted to get, MacBooks, basically business gadgets that were just lying around, and donating them to children or families who, on the lower end of the income spectrum because of Corona. And one thing we ran into was they had all these items lying around, but IT security said, listen, it's just too much effort for us to wipe them securely, to get them to a point where someone else can just install the machine, because you need to install operating system, there's licensing involved. So there's actually a lot of work involved for someone who says, yeah, I don't use this laptop, but for me to prepare first to get it done, it's a lot of time involvement in getting this up to speed so someone else can even use it. So I would imagine that is a huge stumbling block for people to just pass on their gadgets if they don't want to wipe them, or someone needs to prepare them so someone new can even use them without having to, I don't know, install their own Windows again, or Mac OS.
Well, in general terms for phone, there is a significant supply chain certified with security routes in order to get these various components securely and safely into the right places. But you've hit the nail on the head. We're talking about an element of what is already insured and what is already repaired, and decisions are made around by insurers and parties like us. What do we know? There are lots of gadgets, small gadgets, which are still being hoarded in people's homes because they don't know what to do with them. They don't know how to repair them. They've been perhaps designed not to be able to be repaired. I think, 74 gadgets in an average household, according to a recent survey I think I read, of which 13 are being hoarded, of which a number are broken and a number are perfectly capable of being used again. Knowing that we had this conversation, I did a little inventory of our own household, and I don't really want to be too embarrassed, given I think of myself as being relatively environmentally friendly, and I clearly understand this industry. But when you start to step through the amount of toys and gadgets or things that were used at one point or another and now aren't, it's a little depressing. So I think we have a long way to go. And if I'm going for hard, it will be creating a product which helps to ensure devices are protected that are being insured. So that could be the use of cases, the use of screen protectors and the like up front, and would offer somehow a means of urban mining stroke collecting and repairing devices which aren't being used, because ultimately it's like an iceberg. We are only seeing a small part of the total problem, and recycling isn't. It is part of the answer. But what do we know? Recycling doesn't, create costs and doesn't collect all of those items and precious metals and the like that we use to make those devices in the first place.
Do you believe for such a system that any attempt to pass on the economic benefit of anything other than stable premiums local, because there have been different startups about on the one end, I don't know whether they're still doing it, Laka with bikes was kind of, we are, you get an admin fee, but basically you do not benefit from the underwriting profit. You pass that on to lower claims directly to the insured population. Do you feel that is even sensible or just overly complicated, and you can just say, hey guys, there are stable premiums, we are even if it's not actually a mutual, we will try to pass on, we'll do it with information, we do it on the whole, and we'll do some more information and reporting, but ultimately you can look into our books, and if we reduce claims costs by 20%, we'll pass on half of that 75% of that onto you, and the rest we do to reinvest, to make the product better, et cetera, et cetera. How relevant do you think is that direct economic distribution, assuming that we all, what is it? Homo economicus, like would actually act on these economic imperatives, or it's just convenience and something else?
I think you've got to make it more direct than that and simpler than that. I like these concepts, but I think you've got to, voice the green credentials, why it's worth doing something. But the direct call to action is what will make a difference, and from day one, rather than something nebulous sometime later. That's just my own personal opinion. I think some of these companies look great, have great messaging, and are clearly doing very well. But if I were to able to nudge somebody through an economic advantage to them directly for doing something, if I were to offer them some form of subscription service, and let's just take it away from insurance slightly, that would enable them to send in or have collected devices which they no longer need, almost a concierge service to be dealt with via repair or resale, and perhaps some participation in those elements, and possibly the downloading of an app results in a lower premium over time too, because they have done something themselves. So this is very much direct marketing to that individual. You may find you get cut through. I think these other concepts sound great. They promote the values, the brand values of the companies, but they're hard concepts for busy consumers to really grasp quickly.
Yeah, I think that's. Thank you. I think that makes absolute sense. Toby, we're running out of time, unfortunately. This truly flew, and this was. I thank you so much for kind of digging in and picking up, peeling the onion, and we could spend hours talking about this. I guess where I would like to end this podcast would be, our listeners consist of insurtech, insurance professionals, within the European ecosystem. Is there anyone that you would like to talk to, anyone that you wouldn't like to talk, any shout out? What are you looking for? And any conversations you would like to have following this?
So I've enjoyed it, Nick. Thank you. And thank you, Tom. I think it's a really, insurance and insurtech's a really interesting space. I saw something, I subscribed to Strava, and Strava sent me an email yesterday which was talking about cycle insurance and Sunday. So I've done a partnership with them over cycle insurance. Really nice, really good intent, and I'm always interested in talking to anybody who's got an interest in our products, but particularly where they're, from a ticketing and or phone gadget perspective, they're connecting to groups and communities that have higher intent. We're never going to be going up against a large business for bank assurance, but I think our systems and our approach to partnership mean that acting with groups of parties where we can create value for their customers, particularly with the digital experience, is something I would relish a further conversation.
Toby, thank you so much for your time. It was a true pleasure.
Likewise.
Thank you, Toby.
Yes, Tom.
Take care. Bye.
Bye.